And I'd like to thank everybody for joining us today. This is the Earth Equity third quarter webinar. We've been doing these for several years now, and it's always fun to take a few minutes and go through what we've seen for the last quarter, maybe talk about current events, give you some updates on what's going on with Earth Equity, with our team members, etc. So I am going to start our PowerPoint here. And we will get started. And of course, we'll start out with the disclaimers, same things that we typically put out here, etc. And move on beyond that. So our agenda is pretty much what it always is. We're going to talk a little bit about markets, or we're going to first give you an Earth Equity update, talk about markets, give you an economic update, inflation, interest rates, and other things that we see that's happening. We're going to touch on geopolitics for a moment. I'm not going to get too deep into that, but just enough to say where we see some potential negative impacts are. We always go through portfolio construction. I think this is an important part for both new people who are joining us and for folks who have not been with us before, to be able to learn a little bit about our portfolio construction, maybe some changes we've made, and then we'll do a Q&A. So we'll hope to have everybody wrapped up. We almost always come in right at 3 o'clock after Q&A, so let's get started. So most of you know, of course, and I would hope all of you do, that we teamed up with Prime Capital Investment Advisors right at the beginning of the year. We continue to integrate our systems with Prime Capital. It is really, really, really agonizingly close to finish, but one of the most important things I want to say to everybody is thank you so much for your patience. There still are a few more hurdles to cross, but we are almost all the way there. And I know that it has been a strain, especially on my team, but also for some of our clients as well. So again, thank you so much for your patience. And we are really, really looking forward to getting past this transitional period and getting back to really focusing on the things that we do best. The Fidelity custodial transition is almost complete. There are just a few of you out there who have yet to finalize those documents. If your advisor hasn't yet followed up with you for those remaining few, please get those documents done as soon as possible. And our operations team, Rebecca, et cetera, basically told me, as we get towards the end of the year here, if you're making distributions, say charitable distributions, we do a lot of charitable distributions at the end of the year. Get started on those now as soon as possible, because everybody doesn't want to be doing this at the end of the year. So, please make sure that you're reaching out to Rebecca and making sure that any end of year plans that you need to do, you get started as soon as possible. In terms of online access, this is the same slide I used last quarter, but please make sure that you're using Orion if you possibly can. One of the big reasons is on there you can see the different models that you're in. I am going to record a how to use Orion very soon here, once I'm done traveling at the end of this week. So we'll have that out to you soon. But one of the biggest advantages that you're going to find is that we're going to be able to, once we finalize this transition over to Fidelity, we're finally going to be able to transition over the performance history that we've logged going back to Axos, our previous custodian. So log in.orionadvisor.com. If you have any questions at all, please reach out to Rebecca for that. So I want to start out our real update here, though, by shining a spotlight on 100 Women Who Care Asheville. This is an organization that was started out of this office here. And they have a gathering actually tonight, October 24th, when we're recording this. It's the 3-year anniversary for the group. Over $100,000 has been donated to local nonprofits here. That is just an amazing amount over the last 3 years. And I want to call out our two amazing teammates, Lisa Sluter and Carrie Keene, who have been an amazing driving force for this. And we really only see the amounts that we're donating getting ramped up. For those of you who don't know about 100 Women Who Care, I'll give you a very, very brief primer on it. It is a giving circle, and basically what happens is every quarter the group gets together. Every individual member gives $100 on that quarterly basis. When they get together, there are 3 nonprofits that come in and present. The group as a whole votes as to which nonprofit gets the money. And so it's obviously easy to figure out. If you've got over 100 members, that's $10,000 plus per meeting. They've also done a great job of getting some matching grants. So their impact has been just huge. So if you're local and you're not a member, we would love to see you become a member. And if you're not local, it's just something that if you're interested in creating this in your own community, reach out to Lisa and Carrie about. But I'm really, really proud of the work that they've done with this. We've also done some fundraising. Lisa hosted a fundraiser at her home for Creation Care Alliance, which is part of Mountain True. Mountain True is the largest environmental nonprofit here in Western North Carolina that we have been supporting for years and years and years. So we were excited to be a part of that. I have been traveling nonstop, and I am really happy and ready to be home. So I attended the Future Proof Conference out in California, which is actually a conference that was outdoors. It was unlike any industry conference I had ever been to before, where they put you in a convention center. It's all artificial lighting. This was actually outdoors. This is me being interviewed for CityWire, and we get to wear shorts too. Interviewed for CityWire, and you'll notice my shirt says ESG investing is not sustainable investing, which is something that I've been preaching for years and years. And we continue to get the word out. Carrie was also in California not long after I was, and she was a panelist at the RIA West conference out there. So she is on the speaking circuit as well. I got to visit New York City during Climate Week for some Climate Week events, but also for a lot more media appearances. So I was at the NASDAQ market site. This is that cool studio where if you're walking through Times Square, you can look in and literally watch us recording this, which was really fun. And if you haven't seen this video, we have it on the website. I have it actually in my email signature as well. Visited News Corp and Dow Jones, so was interviewed with Barron's. And I had the amazing opportunity to meet Jane Fonda, who was speaking at an event for Climate Week as well. So it was definitely an interesting and fun time up there. But again, it's been a lot of travel of late. We were in the media several times, which we typically are. I wrote an article for Crane Currency, another one for Kiplinger, and then for Forbes as well. But we were also quoted in a number of other publications. We have something really, really exciting that's coming up. I know I have teased this with several folks, but we have a new video podcast that's coming up called Dollars and Change, the Expert's Guide to Sustainable and Responsible Investing. We're real excited about this. We haven't been able to find something similar in the marketplace. And so with the support of my team here, plus the marketing team at Prime Capital, plus Abby Sheridan, who I work with on PR, we came up with this idea. And my first guest was actually when I was in Los Angeles. I got to go to the home of the actor and environmental activist Ed Begley Jr. And so I'm going to slide onto here, and I think Ed wants to say hi.
So grateful that you and I have the ability to vote on election day, but we also get to vote in the supermarket aisles and the showroom floors, the appliance stores with our purchasing power. But another very important vote, I think the most important, is how we vote with our investments.
Absolutely.
And you're doing a great job with that, with sustainable investments, your eye towards the environment and being environmentally responsible in every way. So thank you for that, Pete. Keep it up.
Thank you so much, Ed.
Thank you.
And so that was a really exciting opportunity to spend some time with Ed Begley Jr., who I've actually known for several years, but we hadn't caught up for quite a while. But he invited me into his absolutely beautiful LEED Platinum home. The first episode of this, I just saw the first cut, literally the last couple days here, or at least the first edit of it. And so we should be coming out with that really soon. And you can see there's a number of other episodes that we've recorded that are ready to be edited and ready to be put out to the world, including folks from a broad range of sustainable investing. So we're real excited to get this launched. So let's jump into headlines. We always take a look at headlines to start out because there's so much going on. It always seems like every quarter when I put this together, there's more and more and more that for me to pull from on this. Obviously, everything that's going on in the Middle East, to inflation, to bonds and interest rates and things. But there's always something going on. So these are some of the headlines that I'm keeping an eye on as I check my feeds every morning. Let's take a look at performance here. So this is performance for the for the third quarter of 2023. We can see that nothing was up for the third quarter. The S&P, so the broad measure, was down about 3.3. Developed international was down almost 5. Bonds were down 3.22, and we're going to spend some time talking about bonds in just a little bit here. Small cap companies were down 5.2, but one really important one, especially for our business, is that clean energy stocks were down almost 17% in the quarter, not the year, but in the quarter. And so that's one of the important things when we're putting our portfolios together. A sustainable portfolio isn't just buying clean energy; it's buying a broad group of different kinds of companies that aren't just focused on one particular theme or sector. And we'll go through how we build portfolios a little bit farther on, but I wanted to point that out. This is the year-to-date numbers. We do see some positives on the S&P 500, but pretty much across the board, nothing is really performing exceptionally well this year. And I think we're probably all quite aware of that. This is a very, very challenging market environment. Everything from stocks to bonds have really not performed. And I think there was a headline I saw last week that basically said the 60-40 portfolio, which is 60% stocks, 40% bonds, which is a sort of a go-to balanced portfolio for many people, had its worst year ever last year. And so this is, again, like I said, this is a very challenging environment, and geopolitical issues are not making it any easier. This is going back 1 year, year over year, going from the end of the third quarter last year through the end of the third quarter this year. We continue to see clean energy down, and the majority of that reason is because interest rates have gone up, and clean energy is typically a growth industry. And anytime you have a growth industry, they rely on credit, and that's a big part of the growth. And so that's partly why we're seeing what we're seeing. We're also seeing some volatility if you look at the ups and downs of that. But realistically, the U.S. has not been the best performer over the last year. It's actually developed international with the MSCI EAFE here at up almost 26% for the year. This is going back 3 years. And so, we see a lot more volatility as well, especially once again in clean energy. But nothing over the 3-year period is really standing out all that much. We've got some decent returns in the S&P 500, but I'll have some comments to talk about that in just a moment. But nothing is really standing out over this 3-year period. There's a lot of lateral movement, if you will. And of course, we go to the 5-year, we saw a huge run up in clean energy, but since the beginning of 2021, it's flattened and gone down over that time period. Looking across the board, S&P 500 over that 5-year period up almost 60%. Emerging markets haven't made a penny, down 0.92. Bonds up 0.38. Not a whole lot going on there in some what should be non-correlated assets. So I'm going to launch our first poll of the day here. And we're going to start out with getting what your opinion on the economy is right now. Are you positive? Are you neutral on it? Or are you negative? Let me know what you think. We have 38 people on right now, about half of who signed up. Not seeing a single, there we go. Somebody's positive. That's nice to see. Most people are neutral and negative. We got a couple more. Anybody else want to finalize and give an opinion here? In 3 seconds. And I'll end the poll. So you can see that about 1% or 10% of you have a positive view. Half of you are neutral, and about just over 40% are negative. It's interesting because a lot of the economists are now starting to say that we probably won't move into a recession. And a lot of those same folks were saying we were definitely going into a recession last quarter and the quarter before. So it'll be interesting to see where we go. I tend to be in the neutral category right here because there is so much uncertainty, and uncertainty can typically be a negative for the markets, but that also leaves room for positives. So thank you for contributing to that, and we will move on. So looking at the economy, the Fed has some absolutely difficult decisions to make because the data is coming in just pretty much all over the board. And so really, we're just sort of stuck in this waiting game. Are they going to raise rates again? Are they done raising rates? What does inflation look like? What does the labor market look like? There are so many contributing factors. And so it's hard to really project out where we're going to be a year from now, much less 2, 3, 5 years from now. Like I said, the labor market is still tight, but inflation has finally gotten close to acceptable levels. I said this on the last call, and I'm going to make sure to say it again because I know we've had conversations with some clients that still are sort of in the old mentality that we had even just 6, 12, 24 months ago, where you can't make any interest on your cash. Right now, there is lots of interest to be made in short-term cash, money markets, things like that. So there's no reason why anybody should have at this point any kinds of cash or any kind of money market that isn't earning well over 3 or 4% at this point. We haven't seen this since many, many years ago, almost going back to when I started in this business, and that's a long time ago, back in the early 2000s. So we have a little bit more flexibility in terms of how we can manage portfolios to help get you more yield without having to have the risk that might be in the equity market. So this is something certainly to look at. I'll get more into bonds in just a few moments. So in terms of the markets, PE ratio, of course, is the multiple or the valuation of markets of stocks. And so the price to earnings ratio, the valuation on the S&P 500 actually dropped down after last quarter. You can see that it still is higher than its 25-year average by just a little bit, not quite 1 standard deviation. But that tells us that there is a slight overvaluation based on this data from JP Morgan. This is one of those things where the S&P 500 has some other aspects of it that we really need to keep in mind when we look at numbers like that, because 10% of the S&P 500, 10 stocks make up 32%, almost 33% of the index. And what that says is those 10 stocks, they're typically growth stocks. So you're going to have the Apples of the world in there, the Microsofts of the world. And so they're going to typically have a higher valuation. And so they're going to sort of throw off the numbers quite a bit. They also throw off the performance quite a bit because there's 490 stocks that are making up 67% of the index. And so, as we go forward, I think it's important that we keep in mind, that we bear in mind that we have to look at the S&P 500 with a grain of salt, because it isn't an even weighted. One of the things that we probably all should be looking at more often is an even weighted index, as opposed to something like the S&P 500, which is based on market cap. So the bigger the company you are, the bigger weight you have in the index. So that those top 10s are great, 1% greater than they were last quarter. I've used this next chart from JP Morgan the last few quarters as well. And this is looking at consumer sentiment, which is what this chart is. But it also looks at how the market is done from peak to trough. So, typically when you hit a trough, which looks like our trough hit back in June of 2022, the average return at 12 months after that is almost, is 24%. So there's a really nice bump up from that. I don't think we're quite seeing that yet, but at the same time, there is opportunity. The old adage, of course, is buy low, sell high, but it's so much easier to buy when we're high than when we're low, that we need to be reminded of this on a regular basis. When markets are going down, that's the time to accumulate. I know we have a lot of clients that do what's called dollar cost averaging, or basically buying over a set period of time, or they make contributions every month, different things like that. That's an important way to take advantage of lows like we have right now. Unless you have a very short time frame, these are times of opportunity. Inflation has dropped considerably, which is really good to see. Hopefully, this will stop the Fed's progress of raising interest rates. Obviously, like I said earlier, that's still an unknown. We're still waiting to see what they're going to do, but we certainly have seen inflation drop considerably. But there still are several developed markets that still have fairly high inflation relative to the past. And so things are coming down, but there still is work to do in some developed markets. When we look at emerging markets, it's not as much of a problem. And so doesn't necessarily mean we want to invest in emerging markets or put a lot of money in there. We typically have some in our fund portfolios. But in terms of risk versus return, it doesn't quite hit what we'd like to see. This is contributors to headline inflation. So we can see in general, the overall drop has certainly happened. Energy prices have had a negative impact on that. But there's been a huge part of that we see. If you look at the dark blue at the bottom, and that's shelter, that's housing, has really considerably moved up. And a big part of that obviously is interest rates, and mortgage rates have hit a peak in the last week or two here. And what that's done is, and I like this is my random but important charts, but what that's done is basically made housing very, very unaffordable. And you can see this is going back, well to the mid to late 80s, excuse me, where we haven't seen housing unaffordability since going back to there. That, I have a personal story going back to when my brother bought a house during that time, and he had an 18% mortgage. So we're not quite that bad, but housing affordability certainly is an issue, and certainly something that we need to be aware of. Another important chart is we see delinquencies starting to rise a little bit. Now they're nowhere near the levels that we saw back in 08-09 during the financial crisis, but they are starting to edge back up again a little bit. And so this is something important to keep our eyes on. We've seen debt service ratio, so in other words, the ability for households to pay their debt rise back up, but it's historically still at a very, very reasonable and manageable level. Household savings continues to remain high. A lot of that savings, of course, happened during the pandemic when people weren't spending money. But we are spending that down. You can see the blue line, personal savings has gone almost down to zero. So we're starting to see that number of excess savings start to drop some. If you see my lights here are acting weird on me. Sorry about that. And finally, consumer debt has started to come back up again, but once again, it's still low relative to historic numbers. Doesn't mean that it's good, but it certainly means that we're in an acceptable area for consumer debt. So I want to talk a little bit about bonds. There's been a ton about bonds in the news. Wall Street Journal has had a lot on it. New York Times has had some on it as well. So the Fed has raised rates, and we all know about this, and it's gone up very, very quickly. Excuse me, my throat's getting dry. And you know, based on what JP Morgan thinks, we're pretty much, if not at, we're pretty darn close to really where rates are going to top out. And so this has done a few things to the bond market. Obviously, we've seen negative bond returns for pretty much the last couple of years here. One of the things when we're putting together our fund portfolios, maturity, or how long it is till the bonds that are in those funds mature, is a really, really important part of that, because the shorter you keep your maturity, the less volatility you will typically have in those bond portfolios. So right now, when I ran the numbers at the end of last week, when I was creating this presentation, our bond portfolio was about a 5.7-year maturity. And so when you look at this chart here, you can see that in 2023, you know, if you've had real short bonds, then you did a little bit, you did all right, because short duration bonds weren't hit quite as hard. But look at the 30-year bond, because interest rates have gone up. Prices of bonds have gone down. I'll show you a chart on that in just a second. But 30-year bonds, long-term bonds, down 10.5%. We typically look, of course, at bonds as being a more stable asset class, right? So when I look and see that we've got a 5.7-year average maturity in our fund portfolios, and I see that the 5-year is down about a half a point, that makes me, that reinforces in me that we're really doing the right thing for clients, and really making sure that we don't have long bonds out there that are going to have a major negative impact on client accounts. Because as I've sort of taught in the past, as interest rates rise, bond prices fall. There is an inverse relationship between the two, because when you float a bond as a company or as a country or as a municipality, you float that at a particular percent. So let's say your bond is $100 as face value, and you're going to pay 5% on it. If interest rates go up, the market price for interest rates goes up. That bond is no longer competitive at 5%. Let's say it goes up to 6%. So in other words, the only way for that particular bond to pay a 6% or a market-based yield is for the price of that to go down. So you have to pay less for it, but you're getting what would be the equivalent of a 6% yield. That's the inverse relationship between interest rates and bond prices. And so that's why when we see interest rates go up, especially on the 30-year bond, it has a really, really negative impact. This I took from, I believe this is a New York Times clip that I took, but investors are calling it the Fed Reserve may be done raising rates. If they raise again, it may be one more time, but we're pretty darn close, I believe, to the end of this. There's been a lot of volatility, and there's been a lot of opportunity for higher yields. But again, as interest rates start to fall, which they will at some point, bond prices will go up. And so we see that as a potential opportunity. We're not necessarily trying to time the bond market, but we're certainly well aware that now is probably not a bad time to start looking at not long-term bonds. We really want to be careful of that because of the potential swings, but excuse me, intermediate-term bonds, typically in the 5 to 10-year range, where we can see not only that nice yield that's coming to us, but also potential for capital gains. So I really love this chart, and I'll do my best to explain it to you. So the blue is a 1% fall in rates, and the gray is a 1% rise in rates. And so this basically shows us what a 1%. This shows us when interest rates rise, bond prices fall, et cetera. This shows us an example. So if we look at, say, a 5-year bond, there's not a whole lot of negativity in terms of the in terms of our capital loss on that. We saw it was only 0.5% for the year. This is showing long term that it pretty much stays the same. But when interest rates drop, the blue shows that we have a potential for a 9% capital gain on that bond. Likewise, we can see as we go down the list here, the 10-year, if the 10-year goes down or goes up 1%, the value of that bond typically will go down about 3.3. But if interest rates go down, you've got a potential for a 12% capital gain on that. And so this is where we see opportunity right now, and where we'll start to see in our fund portfolios a higher allocation of bonds, which we are going to do this quarter and raise bond allocations a touch. You'll more than likely see more of that come at the beginning of next year. Excuse me. But it's also an opportunity for in the Treasury and the agency market as well to get some really nice yields. Geopolitics. We're not going to get into this too much, but other than to say, Ukraine, Russia continues to drag on with no end in sight. It's interesting if you watch the news as often as I do. You certainly have seen Russia, Ukraine drop down the headline list with everything else that's been happening. Russia and China relations continue to be concerning. I don't think that they are friends, but the more that they coordinate, I don't think that's necessarily good for Western economies. And of course, Israel, Hamas. This is a conflict that adds even more tension to global economic uncertainty. But when we really think about and put all of these together, one of the most important things we can be doing is focusing on something that is really, really impacting every single one of us. And that is, how do we address climate change? How do we address sustainability? How do we address resilience? The amount of money that we're spending on killing each other could be so much better spent in figuring out ways to address our global systemic and issues that really affect all of us. So, aside from that, we have to continue to believe that we have to be cautious in all of our asset allocation models relative to this, because there is so much uncertainty that's being thrown into the system. And again, our existential crisis of climate change is really where we need to be focusing our attention. Speaking of which, just a few changing economy charts for us here. The planned new generating capacity, and this is just here in the US, but it's great to see that the vast majority relative to everything else, 54%, is in solar. Another 11% in wind, and a big chunk in battery storage. These are all areas that are contributing to, number one, to a more resilient, a more sustainable economy. But number two, this is where we want to be investing, because this is where the next economy is happening. Interestingly, we hear a lot of rhetoric about China, but China continues to lead in renewable capacity additions because they have such a tremendous demand for electric. They still are adding coal, which is a problem, but they are outpacing the EU, the United States, India considerably. Even just going back 4 or 5 years here. In terms of their solar, wind, hydro, and other renewable additions to their generation mix. So opportunities across the globe, but I just wanted to make sure that people saw that, hey, China is doing a lot of things wrong, but they are doing a lot of things right, and clean energy is a big part of that. Energy storage is going to be a major, major opportunity. I think I might have mentioned on our last quarterly that I had a chance to spend some time with the lady who runs the Long Duration Energy Storage Association, LDES, when I was at an event in North Carolina at UNC over in Chapel Hill earlier this year. And her job is really to promote long duration energy storage. And what I think is interesting about long duration energy storage is it's not just about batteries like lithium kind of batteries and things like that. It's a broad array of different technologies, everything from pumped hydro, which is where they you have a reservoir and you can pump water during off-peak hours, up into the higher reservoir and then let it go through the turbines during peak times, to things like gravity, where during off-peak you move large weights up almost like an elevator, if you will, and then when peak time comes, you release that weight, and that weight creates something that spins a generator and does and generates electric that way. So you've got really rudimentary ways of long duration energy storage, as well as things like Tesla does with their actual utility scale, lithium ion kind of batteries. EV transition continues to grow. This is a projection from Bloomberg New Energy Finance that takes us out from where we are to 2040, where we see as much as 70% out over the next 17 years, 70% or 70 million different 70 million cars. Sorry about that. But when we look at the percentage on the right-hand side, we're going well over 50%. The U.S. is looking out at 80% by 2040. So big opportunities in this arena too, and there's going to be a lot of companies that really benefit from this. So we're going to slide into our investment philosophy, and I think it was the last quarterly that we had one of our new colleagues from Prime Capital Investment Advisors was on here, and he said, "Hey, Pete, did you realize that Wayne Gretzky is wearing an Oilers jersey?" And I looked at him and I said, "You are kidding. I never noticed that. It never clicked for me." Obviously, we don't invest in oil, but I can't imagine Wayne Gretzky being in any other jersey, so we'll continue to go with this. Anyway, he said we need to skate to where the puck is going, not to where it's been. That's our investment philosophy. That's where we believe the next economy is moving towards. And so when we're putting together our individual stock portfolios, and to a lesser extent our fund portfolios, these are the areas where we truly believe the next economy is going to thrive. Obviously, alternative energy is a low-hanging fruit, if you will. Everybody knows this is where we need to go. But energy efficiency is just as important. I like to preach that the best kilowatt is the kilowatt that's never used. So anytime we can be more efficient, we want to be more efficient. Energy storage, battery technologies continue to grow. I gave a talk this past weekend at a church down on St. Simon's Island, and one of the questions was, "Hey, Pete, what about all of these minerals and all of these rare earth minerals and things like that are having to go into batteries now?" And it was a really important question. My answer to it is really twofold. First, we have an existential crisis with climate change, so we need to do absolutely everything we can right now to get off fossil fuels, to reduce our emissions, and batteries are going to be a really important part of that, because as we all know, and we've heard this many times, the sun doesn't always shine and the wind doesn't always blow. So we need to be able to store that capacity for at night in solar's case, or when the wind isn't blowing. So it's a really, really important part. The second part of the answer is that technology continues to move forward. Technology continues to come up with cleaner, safer ways to store energy in ways that aren't going to necessarily need the cobalt, the lithium, the nickel, all the different metals and minerals that are necessary for today's version of the batteries that we're using. Water is going to continue to be a really important part, especially from a resilience perspective. I said this before, but if anybody hasn't seen the headlines over the past few months, Phoenix and out in Arizona has basically cut off new home development because they don't have enough water to supply new homes. And so anybody who's out west understands the issues with water. My in-laws who live out in Oklahoma understand the issues with water and these continuous droughts that we're seeing. Another low-hanging fruit, green transportation. Everything from my Tesla to commercial vehicles to industrial vehicles, buses, things like that, all really, really important. Natural and organic products and services. I always love to highlight Allbirds because they're the most comfortable shoes I have and about all I wear. And they actually will tell you what your carbon footprint is when you buy a pair. Sustainable real estate. Real estate is 30 to 40% of our emissions, and so any time that we can buy into companies or real estate companies that are reducing their carbon footprint, that are reducing their water usage, that are reducing their energy usage, it's really important. IT across the board, this is mostly in many ways about efficiencies, how to make processes more efficient, semiconductors more efficient, because semiconductors at this point really rule our world. Every piece of electronics we have has a semiconductor in it. How can we reduce our energy usage, make more efficient semiconductors? Because when you look at this at scale, it may be a very, very small improvement on your iPhone, but when you spread that out across millions and millions and millions of devices, it makes a huge imprint. Green finance, as a lot of you know, I'd love to talk about insurance. That continues to be an issue. Insurers are, in my opinion, going to be a big influencer on climate policy because they're the ones who have to pay out claims. And we're seeing in Florida and California, especially, insurers are saying, hey, there's too much climate impact going on. We're going to pull out of the state because it's not profitable for us to be there. And ultimately, I believe that it's that attitude that's probably going to push for more comprehensive climate policy. Another low-hanging fruit, recycling, circular economy, eliminating the need for the concept of waste in any kind of manufacturing and any kind of consumer goods, really important. Green building technology, of course, relates up to sustainable real estate. And we believe in cutting-edge biotech. And I'm not necessarily talking about big pharma. That's a completely different animal. I'm talking about biotech, which is really researching cutting-edge ways to improve our way of life. I believe that a healthier economy or a healthier society is a more sustainable one, and this is an important part of that. When we look at our Green Sage sustainability portfolio, which is our individual stock portfolio, it is balanced across all sectors. The only sector that it doesn't have is energy, and the energy sector are fossil fuels. That doesn't include solar, wind, geothermal, anything like that. Those are in other sectors, but does not have fossil fuels in there. And when people ask, well, don't you have to have fossil fuels in your portfolio? Well, the answer is really no. Because when you look at what fossil fuels did, going back to 2013 all the way up into 2022, look at the chart. It really had no return. And when you compare that against just a general, the S&P 500, which I said earlier we need to really get away from, but just really looking at what the widely viewed benchmark is, it really underperformed. You didn't get a return. And it wasn't until the beginning of 2022 that we started to see oil come up a little bit. But that's mostly because of inflation and profiteering on their part. But when we compare the energy sector versus clean energy over that same time period, the results are not even close. There's about a 90% difference over that 10-year period, even with clean energy coming down over the last 2 years or so. Love to talk about greenwashing. This is something that we're really, really pay attention to. This is something that I talk about often. I did out at our ESG for Impact conference, where I was on the keynote panel 2 weeks ago in Denver. Right now there's over 600 different sustainable funds. This is according to Morningstar. 600. How do you choose which one is green? How do you choose which one isn't? It's really hard to do. Which ones are sustainable? Which ones have Exxon in them? Which ones don't? It takes a lot of work. This is the list of all the different funds. And I'll use that time to take a drink here, that are sustainable. You know, greenwashing is saying that you are sustainable when you're really not. And we find that a lot with a lot of these so-called ESG funds, which you've probably seen in the headlines often. ESG means environmental, social, governance, and ESG is good. It's an important part of the process, but it is at the end of the day not the end portfolio. Excuse me. I like to pick on BlackRock because they make it really easy. They're actually the second largest SRI ESG fund in the US. They've dropped down because they've had a lot of outflows. With about 12 billion in assets. They started back in 2016. They've got 4 globes according to Sustainalytics. They've got a AAA ESG rating from MSCI. But like I always like to say, it's so important for us to look under the hood, or if you own a Tesla, to look under the frunk, which I love. I've never used mine actually, but and you see what's actually in the portfolio. This is not sustainable. So what they've done here is they've taken a traditional index, they have layered on some of the ESG metrics, the environmental, social, governance metrics, and adjusted the portfolio based on those and called it sustainable. What they haven't done is make it sustainable. What they've done is they've made it a less bad version of the original traditional index. And so when we're looking at funds to put in our portfolios, if you're a do-it-yourselfer and you want to do sustainable investing, you really have to look under the hood, because there is a lot of greenwashing that goes on. Now, the SEC has come out with a rule within the last few weeks here about naming, but it's going to take a while for that to really get rolling and for them to really start enforcing that. So we're going to head to our second poll of the day here. So based on everything that we've talked about here, what is your biggest concern going forward into 2024? Can anybody see? Can everybody? Okay, there we go. Anybody else want to participate? We have almost everybody there. All right. I'm going to end the poll and share it with you. So your biggest concern is domestic politics, and it basically is a dysfunctional system, as we all know. I just read before we went on this that Tom Emmer was selected to run for speaker. We have so many things that need to happen in Congress. Hopefully they will get somebody who can work across the aisle and make things happen. There's a lot that needs to go on, including the shutdown of the government or potential shutdown coming up next month. So lots there. Number 2 is geopolitics. I would tend to agree with you on that one as well. Climate change, it is our biggest crisis. We need to be doing more on it. The IPCC came out and said, not the IPCC, but whoever is looking at where we are in terms of our progress, I can't remember the organization, I apologize for that, but said we're not doing enough. And so we need to continue to be doing more. And then 10% interest rates, 3% inflation. So, we obviously don't have a whole lot of impact on politics right now, but we will next year when it comes time to vote. So please make sure, no matter where you stand, that you are active and involved with that. Interest rates, I tend to think, are going to be less of an issue. I think inflation is going to be less of an issue. And I think we really are going to try to capitalize and be opportunistic when it comes to interest rates. So thank you for sharing your thoughts. So how are we handling the current market environment? So, all of our fund portfolios have stocks in them. We break them down by domicile. Are they based in the US? Are they in developed international? Are they in developing markets? We break them down by size. Are they, huge companies like Apple or companies like that, mid-size, small, etc. And we break them down into bonds as well. So just about every portfolio except for our global equity has got bonds in them. And those are broken down by quality, by duration, like we talked about earlier. We try to keep them fairly low, what their yield is, where they're located, domicile, and do they have a focus? We have climate bonds in every single one of our portfolios, which finance climate projects for companies. And we also include alternatives. Alternatives are a really important part of any well-diversified portfolio because they are non-correlated. So in other words, they don't move in the same cycle as the stock and bond markets, both of which were down last year when alternatives were actually, at least the ones we use, were actually up. And these can be a mix of commodities and currencies, option strategies, et cetera. And so when we look at, this is our core balance portfolio, which is our largest portfolio or model by assets. So what we've got our clients' assets in, we can see that we have, gone up, going back, and this goes back to 2020. So this is a 3-year chart basically here. We started at about 50% in the balance portfolio then. We dropped it down during the pandemic, brought it back up to 60, and now we've tailed off a little bit to about 55%. Bonds, we used to have a much higher allocation. We dropped it as interest rates, began to rise, and we have started to add again over the last couple quarters because we see the opportunity again in both interest rates, so getting a nice yield off of bonds, but B, also the opportunity for capital gains when those when interest rates do come back up, or I'm sorry, go back down. And alternatives, in general we've continued to increase those because it's been prudent to do so. We believe that anytime we can have 20, 25, we even had over 30% in this portfolio a couple times. It's really been beneficial. It has leveled out performance. It has leveled out volatility. One thing to remember is there is no true sustainable alternative fund. The reality is that most of them are derivatives, so we're not actually owning the underlying security. We're not owning the underlying commodity, et cetera. But it's important to know that. But our fiduciary duty and try to put together the best possible performing portfolio for you, it's really important to have these in there. And in terms of cash, we are not holding a lot of cash right now. We could at some point because interest rates on money markets are so good at this point. And this talks a little bit about correlation. So when I'm putting a portfolio together, one of the most important things I can do is make sure that the funds that we put in these portfolios don't all move in the same cycle. So you'll see a lot of funds in here. The orange is a truly negative correlation, but a lot of the funds you see in here are the light blue. Dark blue means that they've got a closer correlation, but a lot of the light blue means that there is not a lot of direct correlation. And this is an important way, an important aspect of putting portfolios together, as is making sure that the funds that we own don't all own the same thing. What happens a lot of times when we have prospective clients come in, they will have a portfolio with a bunch of different mutual funds, but all the mutual funds own the same thing. And so in owning the same thing, they have this false sense of diversification. See, I'm running out of time, so I'm going to go through this real quick here. If you add the alternatives, you typically reduce your volatility, as you can see on the bottom here of this chart, and potentially can increase your annualized returns. We continue to have, I didn't change this again here, I apologize for that. We continue to have a challenging environment. This should say Q3 2023. We saw that growth helped a little bit, but value still is in play. but we are continuing to see that performance is in alignment, and we will continue to make changes as warranted. And I'm really going to zoom through this. I apologize, I've been long-winded today, but these are the funds that we use, the equity funds that we use in our fund portfolios. You can see Q3, everything is down, especially clean energy right here. But when we start to look out towards on the year to date, the 1 year, 3 year, 5 year, everything other than real estate is up over that time. And when we look at some of the funds that we truly believe in, that we have money in, the bigger allocation like Brown Advisory Sustainable Growth, up 10.76 versus S&P 500 at 9. Green Alpha up 13.5 versus 9 again, and on down the line. We take a look at EFA, which is International Developed, the Thornburg fund that we use, up 769 versus its equivalent benchmark, up 3.25. Emerging markets, we use Matthews, that's up 8.8 versus its benchmark up 5.55. So we're really happy with the funds that we have over this time. And this is we'll continue to go through here. Sorry about that. But here are the bond returns as well. And again, we are happy with these as we look over, here bonds are in the upper half, our alternatives are on the lower half here. We're happy with what we've got. And what's interesting, this is a mix of asset classes. So, year to date, an asset allocation fund is up about 4.1%. But if we look at 2022 and 2021, look at this disparity. So 2021, a mix of stocks and bonds was up 13.5. 2022, it was down 13.9. This is how things can change. And this is why it's important for us to constantly be keeping an eye on asset allocation, and why we truly believe that active management is more important than trying to index. Long-term investing, we've shown you this before, but there's a lot of volatility on the 1 year. But as you move out to 5, 10, and 20 years, stocks have always performed well. Now, that doesn't necessarily mean they're going to continue to. As we all know, past performance isn't indicative of future results. But looking on past history here, it has always paid off over these time periods to have assets in stocks. And I love this one, and this is where I'll wrap up on here. If you remain, this is going back from 2003 to 2022. If you were invested the entire time, you put $10,000 in, you made your value was $64,844. But if you missed the 10 best days in the market, it halved that down to $29,708. And if you missed the 20 best days, you're down again. By the time you get here to where you missed the 30 and 40 best days, you actually have less money than you would have if you would have just went through the ups and went through the downs. This is January 2003 through December 2022. So trying to pull in and pull out of the market isn't the best way to go. Stay in the market. If you need to make tweaks a little bit, tweaks are fine, but trying to pull in and pull out and time the market doesn't work. I forgot that I made animations here, so I apologize for that. So in summary, we're going to continue to keep a close eye on the economy. We'll make tactical changes if they're warranted. We are grateful for your patience as we do finalize this transition from to PCIA, hopefully this quarter, and we are always grateful for your business. I had a chance this weekend to see some clients down in Georgia who I haven't seen in a while, and it was really heartwarming to be able to spend some time with them. So with that, we are going to go to Q&A. Here is some more disclosures for you, but let's take a look and see what we have here. Sue asks, if not the S&P 500, what index should we be watching? I would take a look at an equal weighted S&P 500. So you can look that up there. Should be an ETF. I don't know the exact one. I'll look it up here real quick. The equal weighted S&P 500, the ETF is not in front of me here. EWI. So you can look up EWI as a possibility. we speak to clean energy index versus our performance. In general, the clean energy index has not performed well. None of them have. The one that we use in our portfolios, which is QCLN, which is the First Trust NASDAQ Clean Energy. It's a long one. Anyway, it's Q Clean, is the best performing of the bunch. So we'll start out by saying that. Depending on which portfolio you're in, whether you're in aggressive or balanced or conservative, it's going to be a different allocation. I believe in balanced right now, it's about 4% of the allocation. And so being down the most of all of our different funds that we've got, that is, we try to be smart about not overloading in clean energy. Likewise with our Green Sage Sustainability portfolio. It is a percentage of it in clean energy, but we really, really, really want to spread that out to other sectors of the economy, because otherwise you have a sector fund or a thematic fund, and we don't want to look at our portfolios as being sector or thematic. We want you to be able to use them for core portfolios, because that's what we truly believe they are. They're a core portfolio focused on what we believe is the next economy. And so, we don't want to overweight in clean energy, because that would not be the prudent thing to do. And so when you see that I can't give numbers on our individual models for compliance reasons, and everybody's is going to be different based on when they bought in. But that being said, the negative on the clean energy portfolio had a negative impact. But also when I showed you Brown Advisory Sustainable Growth Fund, which has outperformed all of its indexes, that actually is a bigger percentage in the portfolio. So that has a larger weight. That's how we create a portfolio that is going to be really well balanced. Thanks, Mike. How does buying a CD compare to buying a bond of similar duration? They really don't. They're really 6 of one, half dozen of the other. When you buy a bond, like a treasury, for example, it's typically more liquid. And so you can buy or sell that on the open market, whereas a CD, you typically will lose 3 months worth of interest or whatever the bank has numbers on for that. We have some specific recommendations if you want to talk to your advisor. We've got some ideas for some really, really good rates if you want to focus on a bank. We also have some great ideas, if we're looking at buying bonds, treasuries and agencies give you some really nice numbers right now, with some decent durations. Our thoughts on CO2 sequestration. If we're talking about sort of carbon capture, I've never been a big fan of it. In fact, I saw an article today that tried to debunk some of it. I haven't had a chance to read through the whole thing. In my opinion, this is my opinion, I believe it is a way for the big oil companies to continue on the way they do business, to continue on pumping oil out of the ground and just saying, hey, we're just going to pull the carbon out of the air and stick it back in the ground. It's really unproven in many cases, and I certainly wouldn't be investing in it at this point, and I'm not sure we ever will. Ken asks, have you covered this or ignore? What was the return for the quarter and year to date for Yeah, I can. We can talk about those on a one-on-one basis. I can't talk about those for compliance reasons on an aggregate basis here. So are there any other questions while you have me here? I apologize for running over about 5 minutes here. I am grateful for everybody's time today. Any other questions? Well, if I don't see any, thank you all so much. I appreciate your time today. We all, Carrie, Lisa, Neil, Rebecca, and I are all grateful for your business. It's great to see a lot of our Prime Capital Investment Advisor clients and advisors on here as well. So thank you for joining us. We'll see you again in another 3 months. Thanks and have a great day.